All right, today we're going to pull back the curtain on your brokerage account. We're going to look at all the invisible systems, the strict rules that are working behind the scenes 24/7 just to keep your money safe. Let's dive right in. You know, it feels so simple, doesn't it? You tap a button on your phone and boom, you own a piece of a company. But behind that one simple tap, there's this incredibly complex machine of regulations and workflows. We're going to break down exactly how that machine protects you, starting with one of the most exciting parts of investing. Let's talk about IPOs, initial public offerings. For the longest time, applying for one was, well, kind of a pain. But that has all changed thanks to a system that's really designed to put you, the investor, first. The secret sauce to this whole new world is a system called ASBA. Now, the most important word on this slide is blocked. See, when you apply for an IPO these days, your money isn't just taken out of your account right away. Nope, it's just blocked. It stays right there in your bank. And the process itself is incredibly simple. Your broker sends your application, you get a little UPI request on your phone, you approve it. And that's pretty much it. The best part? Your money stays in your bank account, actually earning you interest, until the shares are officially allotted. If you don't get any shares, the block just disappears. It's a total win-win for you. And get this, things have gotten so much faster. The whole timeline has been squished down so that a new stock starts trading on the exchange just 3 business days after the IPO closes. No more of those long, anxious waits. But here is a really crucial pro tip. The system is easy, but it does need you to do one small thing. People who work in brokerage operations will tell you the #1 reason IPO applications fail is that people just forget to approve that UPI request on their banking app. So remember, after you apply, check your phone. Okay, so let's see how this idea of protection works for another really popular investment, mutual funds. In this case, there's a critical rule that acts like a powerful firewall between your money and your broker. It's crazy to think about, but it used to be that when you bought a mutual fund, your money first went into this giant pool account held by the broker. I mean, the potential for misuse was huge, but not anymore. Now, your money zips directly from your bank to an official intermediary, the clearing corporation, and then to the fund. And in return, the fund units come straight back to your personal DMAT account. This one change pretty much wiped out a massive risk for all investors. All right, let's step up into the world of high net worth investing and talk about portfolio management services, or PMS. As you can imagine, because the stakes are so much higher here, the rules are even stricter to make sure only serious, well-capitalized players are in the game. So what is PMS? Put simply, it's like having your very own personal fund manager who builds and runs a portfolio just for you, all based on a very specific investment strategy. But it's definitely not for everyone. The regulator has put up a pretty high wall to protect smaller investors. A broker is absolutely not allowed to accept anything less than 50 lakhs, that's 5 million rupees, from a client to open a PMS account. And the protection actually goes both ways. The company that's offering the PMS has to have a minimum net worth of 5 crores, or 50 million rupees. This makes sure the firm is financially solid and has some serious skin in the game. Speaking of risk, let's look at a product that's all about leverage, the Margin Trading Facility, or MTF. This is where you're actually borrowing money from your broker to invest, and as you'd expect, it is very tightly regulated. So MTF is pretty much a loan that lets you buy more shares than you could with just your own cash. It can amplify your profits, which is great, but it can also amplify your losses, which is exactly why the rules have to be so tough. For starters, not just any broker can offer this. A corporate broker needs a minimum net worth of at least 3 crores. That's 30 million rupees just to even be allowed to offer this to their clients. And the rules get very, very specific. You can only use margin for the biggest, most liquid, top-tier stocks. And any stocks you buy with that loan are kept in a totally separate pledged account for transparency. But look at that third point. That's the most important one. It is strictly 100% illegal for a broker to take idle cash from one client's account to fund another client's trading. That is the cardinal sin of the industry. So far, we've talked about specific products, but what about the apps and the websites that we all use every single day? Well, it turns out regulators have built a kind of digital fortress around them too. These security layers are totally non-negotiable. Every single platform has to use two-factor authentication. That's your password plus something only you have, like a fingerprint scan or a one-time password from your phone. All your data has to be shielded by strong encryption, and brokers have to hire outside auditors to constantly check their systems for any weaknesses. Okay, let's put it all together with a quick real-world scenario. Imagine you're at a brokerage. They're a little short on cash for their margin trading desk. The CFO has an idea. Hey, why don't we just use some of the uninvested cash that's just sitting in the accounts of our inactive clients? Based on what we've just talked about, is this okay? No, absolutely not. It is completely and totally illegal. Misusing client funds like this is one of the most serious things a broker can do, and it is a fast track to getting their license suspended. This is that firewall we talked about, in action. So, what's the crucial point here? It's that these regulations, they aren't just boring fine print. They're like a carefully constructed suit of armor, built to make sure that when you hit that buy button, your money and your investments are as safe as they can possibly be. It really makes you wonder, what other hidden protections are out there? What part of the financial system should we explore next?